Hello, everyone. Welcome to Old School Finance. And today we are talking about one of the most practical investing philosophies ever shared with retail investors: how to make money in any market. Have you ever noticed that most investing advice only works when the stock market is going up? During a massive bull market, everybody looks like a financial genius. You can throw your money at almost any stock, go to sleep, and wake up richer. But what happens when the music stops? What happens when inflation spikes, interest rates rise, and the stock market plunges into a terrifying bear market? For most everyday investors, a bear market means watching their hard-earned retirement accounts bleed out. But for Wall Street insiders, former hedge fund managers, and financial experts like CNBC's Jim Cramer, a down market is not a disaster. It is an opportunity. In his widely discussed investing framework, How to Make Money in Any Market, Jim Cramer shatters the myth that you have to sit back and take massive losses when the economy turns sour. As a former hedge fund manager, Cramer knows that with the right strategies, you can generate wealth whether the market is going straight up, crashing down, or trading completely sideways. Today, we are going to break down the 7 essential lessons from How to Make Money in Any Market. These rules will teach you how to protect your portfolio from economic disaster, spot hidden opportunities during a panic, and build a fortress around your wealth. Make sure you watch until the end because lesson number 7 reveals the exact strategy that millionaires use to survive a recession. Let us begin. Lesson number 1. There's always a bull market somewhere. When the news anchors declare that the stock market is crashing, they're usually talking about the major indexes, like the S&P 500 or the NASDAQ. But the stock market isn't just one giant monolith. It's made up of dozens of different sectors. And Cramer's number 1 rule for making money in any market is recognizing that even on the worst days, there's always a bull market happening somewhere. This concept is known as sector rotation, and it's the secret weapon of professional hedge funds. Let's look at an example. When the economy is booming, people have extra cash to spend. During these times, technology companies, luxury brands, and travel stocks explode in value. But what happens when a recession hits? People stop buying expensive gadgets and stop going on vacations. The tech and travel sectors crash. However, people still need to buy groceries. They still need to pay for electricity. They still need to buy medicine. So, while the technology stocks are plunging, the money does not just disappear. Institutional investors take their money out of tech and they rotate it into what are called defensive sectors. These include consumer staples, utilities, and healthcare. Suddenly, while the rest of the market is bleeding, the stock of a boring grocery store chain or an energy provider starts climbing. To make money in any market, you can't just hold the same stocks forever. You have to learn to follow the money. When the economy is strong, you want to own growth stocks. When the economy gets weak, you must rotate your portfolio into the defensive companies that sell the absolute necessities of life. Lesson number 2. Do not fight the Fed. If there's one entity that controls the direction of the stock market more than anything else, it is the Federal Reserve. The Federal Reserve controls the interest rates of the United States, and Cramer warns that if you try to bet against them, you'll get crushed. Here's how it works in plain English. When the economy is struggling, the Federal Reserve lowers interest rates. They make it incredibly cheap for companies to borrow money. This floods the market with cash. Companies expand rapidly, and stock prices go to the moon. This is a massive, raging bull market. But when the economy runs too hot, inflation becomes a problem. The prices of gas, food, and housing skyrocket. To stop inflation, the Federal Reserve has to raise interest rates. Suddenly, borrowing money becomes incredibly expensive. Companies have to lay off workers, corporate profits shrink, and stock prices come crashing down. Cramer teaches that amateur investors lose all their money because they ignore what the Federal Reserve is doing. They keep buying high-risk growth stocks even while interest rates are rising, hoping for a miracle. If you want to survive, you must listen to the Fed. If the Federal Reserve is raising rates to fight inflation, you must immediately play defense. Sell your high-risk, unprofitable companies. Move your money into massive, highly profitable, established businesses that don't need to borrow money to survive. Do not try to be a hero. When the Federal Reserve raises rates, the smartest thing you can do is step out of the way. Lesson number 4. The buy and hold strategy is dead. You must buy and do homework. For decades, financial advisors have preached the exact same strategy. Buy good stocks, close your eyes, and hold on to them forever. Cramer argues that in today's hyper-fast, globally connected economy, buy and hold is a recipe for disaster. The world changes too fast. A company that looked like an unstoppable monopoly 5 years ago can be completely destroyed by a new technology today. Think about massive companies like Blockbuster Video or Kodak. The investors who bought and held those stocks forever ended up with absolutely nothing. If you want to make money in any market, you can't just abandon your portfolio and hope for the best. You have to actively manage it. Cramer calls this buy and do homework. When you buy a stock, you're buying a piece of a living, breathing business. You need to read their quarterly earnings reports. You need to know if their profit margins are shrinking. You need to know if their chief executive officer just quit, or if a new competitor is stealing their customers. If the fundamental facts of the business change for the worse, you must sell the stock. It doesn't matter how much you love the company, and it doesn't matter if you've owned it for 10 years. If the story changes, you change your strategy. Blind loyalty to a stock will only cost you money. Lesson number 4. Dividends provide a margin of safety. How do you make money in a market that's doing absolutely nothing? Sometimes the stock market enters a period of stagnation. The prices of stocks bounce up and down, but over the course of an entire year, they end up exactly where they started. If you only own stocks that rely on price appreciation, meaning you only make money if the stock price goes up, a sideways market is incredibly frustrating. This is where dividends become your best friend. A dividend is a cash payment that a company gives directly to its shareholders, usually 4 times a year, simply as a reward for owning the stock. Cramer is a massive advocate for owning dividend-paying stocks, especially in a terrible or flat market. When you own a portfolio of high-quality dividend-paying stocks, you get paid in cold, hard cash every quarter, regardless of what the stock price is doing. And even better, companies that pay consistent dividends are usually the most financially stable businesses in the world. They have massive cash flows and steady profits. By investing in these companies, you create a margin of safety. If the market crashes, the dividend payments act as a cushion, softening the blow. And if you take those cash dividends and reinvest them to buy more shares when the stock is cheap, you will experience explosive wealth growth when the market eventually recovers. Lesson number 5. Cash is the ultimate strategic asset. One of the most dangerous myths in investing is the idea that your money is being wasted if it's just sitting in cash. Financial planners will tell you that inflation eats away at your cash, so you must have 100% of your money invested in the market. Cramer vehemently disagrees. He believes that cash is not a penalty. Cash is a powerful strategic weapon. To navigate any market successfully, you must always keep a portion of your portfolio in cash. Why? Because the stock market is fundamentally irrational. Every few years, Wall Street panics. An unexpected news event happens, and investors blindly sell everything they own. Phenomenal, world-class companies will see their stock prices drop by 20, 30, or 40% in a matter of weeks for absolutely no logical reason. If you're fully invested when this happens, you're trapped. All you can do is watch your net worth plummet. But if you have a strategic cash reserve, you are in the driver's seat. While everyone else is panicking and crying over their losses, you get to step into the market and buy shares of the greatest companies on earth at a massive discount. Cash gives you options. Cash gives you peace of mind. Without cash on the sidelines, you can't take advantage of the market's biggest mistakes. Lesson number 6. Sell the rallies and buy the panics. This lesson is all about mastering market psychology. In a bear market, the stock market does not just go straight down in a straight line. It drops sharply, and then suddenly it will bounce back up for a few days. Investors get excited thinking the worst is over, and they rush back in to buy, but it is a trap. A few days later, the market rolls over and crashes even lower. This is what Wall Street calls a dead cat bounce, or a bear market rally. Cramer teaches that you have to flip your psychological programming. Most people buy when stocks are going up because it feels safe, and they sell when stocks are crashing because they are scared. If you want to make money in a bad market, you must do the exact opposite. When you are in a bear market and you suddenly see a massive multi-day rally where everything is going up, that is not the time to buy. That is the time to sell your weakest stocks and raise cash. You are selling the rally. Conversely, when the market experiences a violent, terrifying drop and the financial news networks are telling you the world is ending, that is the time to slowly start buying. You are buying the panic. By selling into the temporary rallies and buying into the deep panics, you constantly lower the average cost of your investments. It takes a tremendous amount of emotional discipline to buy when everyone else is terrified, but that is exactly how generational wealth is built. Lesson number 7. Capital preservation above all else. Know when to cut your losers. We have arrived at the final and most important lesson. In a booming bull market, making money is easy, but in a brutal bear market, your primary goal is not getting rich. Your primary goal is capital preservation. You must protect the money you already have. The single fastest way to destroy your wealth is by holding on to a losing stock, hoping it will eventually get back to even. Let's say you buy a stock at $50 a share. The company reports terrible earnings and the stock drops to $25. You have lost 50% of your money. Human pride is a dangerous thing. Most investors refuse to sell the stock at $25 because selling it means admitting they made a mistake. So they hold on to it, praying it goes back to $50 so they can break even. Cramer is notoriously strict about this. He says your first loss is your best loss. If a company is fundamentally broken, you must swallow your pride, sell the stock, and take the loss. Do not wait for a miracle. If you sell it at $25, you still have half of your money left. You can take that remaining money, invest it in a strong, profitable company, and actually grow your wealth. But if you stubbornly hold on to the broken stock, it might go down to $10 or even $0. Protecting your capital means being ruthless with your mistakes. Cut your losers quickly and let your winners run. Let us do a quick recap of the 7 lessons from How to Make Money in Any Market. Lesson 1. Understand sector rotation. There is always a bull market somewhere. You just have to know where the money is flowing. Lesson 2. Do not fight the Federal Reserve. When interest rates go up, avoid high-risk stocks and play defense. Lesson 3. Buy and hold is dead. You must treat your portfolio like a business and do your weekly homework. Lesson 4. Use dividend-paying stocks to create a margin of safety and generate cash flow in a sideways market. Lesson 5. Always keep a cash reserve. Cash is the ammunition you need to buy great stocks when they go on sale. Lesson 6. Master your emotions. Sell into the temporary rallies and buy during the absolute panics. Lesson 7. Focus on capital preservation. Never hold a fundamentally broken company just to break even. Cut your losers early. The stock market is completely unpredictable. We cannot control inflation, we cannot control interest rates, and we cannot control when the next economic crisis will hit. But we can control our strategy. By applying Jim Cramer's rules, you can remove the fear from investing. You can build a portfolio that thrives in the good times and stands like a fortress during the bad. If you found value in this video and want to learn more about how to navigate the financial markets, please hit the like button and subscribe to the channel. Before you go, let us know in the comments below which of these 7 lessons do you think is the most important for the current economy.